Nitin Bhasin, Head of Institutional Equities at Ambit. Think about the picture. Nitin, so good talking to you. It's been a really long time, and I understand you've been traveling quite a bit, so would love to know how are you thinking about this situation? More importantly, how are your institutional clients globally talking about the current context and their interest in India?
Thanks for having me here. Good morning, everybody. Clearly, when I was traveling for the last 2 weeks, 3 weeks across the world, especially the Americas, you could see that investors were definitely talking about the markets had become heated up towards the September, October last year. So where the correction gives them a hope of perhaps deploying more money in India during the course of the year. But I think still there are a lot of questions around valuations, which pockets to go to, which sectors to look for, or for that matter, what's happening on the consumption, what's happening of infrastructure, capex growth. But people are appreciating that there are opportunities coming up, but at the same point in time, not very aggressively looking to deploy capital in a flurry, waiting out for some economic trends to stabilize. I would summarize it like that.
Right. Nitin, good morning. This is Hiral on this side. An interesting time for you to get to the US as well when Trump is talking about all the possible tariffs on this earth. We've already heard of a 25% in terms of auto that could be coming in. What is the mood check like in the US with regards to where the tariffs go? Because the consensus view is that long term it will not hurt India as much as it would hit the USA itself.
Well, clearly, there are multiple point of views over there, a lot of confusion also, perhaps because we hear about one tariff policy today and perhaps changing next morning. But clearly, India's movement, India's steps in the recent budget or otherwise the government's initiative to go out and connect with the establishment in the US speaks that India wants to listen and India doesn't want to be, tagged as a country which is not open to global trade. So clearly in the near term and in the long term, we understand our country has an opportunity for winning some business from US as it builds its capex, it builds its industry. India has capacities and capabilities. But in the interim, clearly there could be some situations where we miss out on because of certain tariffs. But I would take a little longer view, like 1 or 2 years. But the mood is hence stay away from India for a while because you don't know how the news flow from the US could impact certain sectors, whether it is chemicals, whether it is textiles, or whether it is auto exports, or whether even it is renewable exports from India to that market. So the noise is taking over the next 2 or 3 or 5 year possibilities that Indian companies may have. So hence, a little cautious mood, I would say.
Cautious mood when you come and talk about India. Nitin, with all the FI inflow that started to happen since last week, yes, it's always been a trend. The money comes in the BFSI space and the IT space. Right now, there is cautiousness with regards to IT. So BFSI is what the street is looking at. And I think that has been a sector where people have been watching out for in terms of 2025 as well. Do you think the valuations are right and this is the best time to then look at BFSI?
So, for the last at least 3 to 4 months, our view has been that CY25 will be a year of moderate market returns, which would mean that very unlikely that we will make positive returns, I would dare say that, in India, in broader markets, and more so importantly in the small cap and the mid cap space, we might lose an index level money. But there could be stocks which could actually still make money. So our view has been large caps, and within the large caps, we've always maintained banks is a space to be in. And clearly, you can see that in the last 3 months or 4 months or 5 months, banks have slightly outperformed the Nifty. Banks have outperformed. So hence, that's sort of a place which was not losing you money, even if Nifty may have lost you a few percentage points in the last 3 months or year to date or 6 months. So banks remains one of the ideas that we say that the people should be investing in. Banks are large cap companies. We prefer large caps right now. And large caps is where the earnings are or the earnings momentum is, number one. Number two point is IT, as you mentioned. 2 months back, when we had written our strategy note, we had mentioned that IT is not a place to be in, and the same thing we repeated about roughly 3 months back. Today, after having gone through a significant correction, I would want to say that we would likely to be equal weight on IT right now, given the sharp correction. Uh, uh, Again, so we are still worried about growth estimates. We're still worried about the margin estimates. They could see some moderation, but at the index level, we've seen correction closer to low double digits or so in the index. So hence, IT appears to be not more underweight, but more closer to an equal weight. So that's how I would say about the banks as well as IT right now.
Nitin, just the way the cycle is right now, would it be would it would the market follow a W-like pattern? I mean, typically we've seen V-shaped bounce backs, right, for the last 3-4 years. Could this more be a W, wherein there'll be some uncertainty, some unpredictability, and brace for sharp moves on both sides as opposed to a trending market? Is that a distinct possibility for calendar year 25?
So, before guessing market moves, I would actually want to go back to the earnings. And if I look at long-term cycles of India in terms of earnings, pre-COVID India displayed a very interesting pattern of earnings moderation or cuts of about 7 to 8% median every financial year from the beginning to the end of the year. But post-COVID, last 3-4 years from 20 to 24 was a very different period. Either the earnings went up or the earnings estimates were maintained. To FY25 is one of the years in which we've seen closer to 4.5 to 5% earnings cut at the Nifty level in the first 3 quarters. And perhaps for that reason, could FY25, the kind of signs that we are seeing, very limited pockets of growth and a lot more pockets of concerns or cautiousness. Are we heading into an 25 more closer to 7-8% earnings cuts? We are expecting FY26 to be an earnings growth of 14%, but cyclicals and banks are going to be responsible for most of the growth of those earnings. So if global cyclicals come under pressure, who knows? So I would say we are in the era of where earnings trajectory is changing. Earnings are moving away from a wider market to a narrow bunch of stocks. And that will have gradually, and perhaps that is already shift underway in the markets. So I would say look at that as a point. Number two, Neeraj, is if you look at this quarter, which is about to end today or tomorrow, a very interesting statistic is the index could be down closer to about, at a broader market, NSE 500 could be down about 5%, but a median stock is down anything between 11.5 to 12%. It's pretty much a mirror opposite of what was happening in the first quarter of the financial year. The markets become very, very narrow. And when markets have become such narrow, a concern rises that in the next 3 months or 4 months or 5 months, the domestic market flows, how do they behave as the returns don't look that great for many of the individual retail investors. So I do not know how the seesaw, the W or the V, but clearly we've seen first bounce after a moderation or correction. It could be that we see more of W than a V, but who knows, the right side of the W, is it going to come back to the top points of earlier, or perhaps it looks a little lower? So I would follow earnings, and I would follow performance, and I would follow the entire narrowness of the market. Wouldn't we not be able to give a direction or a shape of the market?
Fair point. And I mean, fairly spoken as well. Unfortunately, out of time completely, but another conversation. Would love to know what is the earnings outlook looking like for FY26 as well. But Nitin, afraid we have to wrap up here today. Thank you so much for being with us and giving us your thoughts.
Thanks for having me.
Follow the earnings, viewers. That's the key message coming in from Nitin Bhasin.